before we sign off, any other saved rounds from anyone here today?
Sorry, I just didn't know what you said. Did you say if we have any other rounds?
Saved round? I don't know where that would be.
Bullets to shoot. Come on.
Hey everyone, welcome back to another Kingscrowd podcast. I'm Brian Belay, Vice President of Product at Kingscrowd. Each week on this podcast, we dive into the world of online private markets and investing, bringing you the latest deals, trends, and insights to help you make smarter investment decisions and capital raising decisions. So whether you're a startup investor, a founder, or just curious about the online private markets, you're in the right place. We will cover lots of good stuff. And I'm very excited today to introduce a special guest for our news segment first, who is Gerry Hays. Gerry is the founder and CEO of Doriot. And we are going to be talking about something very exciting that has just recently launched and Gerry has come up with called VentureStaking. Then in the second segment today, we're going to be going into the deep dive chart of the week, where we will be looking at healthcare pharma trends in RegCF and RegA. Let's jump into the first segment. Gerry, welcome to the Kingscrowd Podcast. Thanks for joining us.
Thanks, Brian. Glad to be here.
Awesome. Now, for anyone who isn't familiar with Gerry, first off, shame on you. You should be, because Gerry has been just in this space and doing so much in terms of education and innovating in the space. So, Gerry, why don't you give everyone just a quick 30-second intro, minute intro, who you are and kind of what your background is?
Yeah, sure. Thanks. And great to be here, everyone. So I've been a venture professor at the IU Kelley School of Business in Bloomington, Indiana since 2004. In the last 7 years, once the RegCF rules started getting promulgated through the SEC, I became super interested in this idea of democratization of venture. And I've spent a lot of time taking a deep dive into this realm, how to bring retail investors into this. We created a game called Fantasy Startup to teach people how to invest in startups. We even created a certification program called QAI, Qualified Accredited Investor, to teach more seasoned investors how to take advantage of the right approach to invest in these startups, just to get every investor, the fullest advantage. And during this time, I was looking at, the challenges that many investors face when they are investing in the startup world, particularly in RegCF, and that is making decisions too quickly, and not being able to take advantage of the power law of venture. And that's sort of what came top of mind for me in creating this new concept called VentureStaking.
Yeah, I think I've seen a lot of great content you've been putting out. And first off, thank you for everything you've done. I will say that I went through the Qualified Accredited Investor, the QAI program that Gerry put together with him and his team, and I learned a ton. So at the time, I probably already had 100 and 150 investment crowdfunding investments and Reg D investments under my belt. I still learned a lot. So it was extremely valuable. I think a lot of investors and founders and even other people who were in the course with me, just being able to go through, have those discussions was a really great resource. So thank you for everything that you've been doing in terms of education. But what we're here to talk about today is the launch of this new approach, I will say, that you've come up with called VentureStaking. So why don't you give us a real quick overview of what VentureStaking is and who the ideal venture staker is? Who is that audience that, it's built for?
Sure. So VentureStaking is built on one fundamental principle in venture, and that is the right to invest in a startup in the future that's winning is more valuable than investing in an unproven startup today. So in other words, what the smartest investors do, whether they were watching Bitcoin or watching other startups, is that they'll wait and watch to see how these assets are progressing. And if they are on the right trajectory, then they'll invest their capital. As retail investors and as angel investors, we often don't get that same opportunity, right? So what we do is we have to make a decision today. And if we don't make the decision today, we might lose that opportunity forever. But what VentureStaking does is it allows founders to come to a community and raise what's called a rights round. So in other words, you can raise, anywhere from $50,000 to $100,000 selling rights to invest in all of your future rounds. And you're not raising equity capital today, you're just selling those rights. And what that does for an investor is that, for example, Maybe you just enjoy investing $1,000 in startups. You could buy a right for $100 to invest $1,000 in each of that startup's future rounds, which gives you amazing optionality. And for 90, for pennies on the dollar, you could buy rights into multiple startups, and then you get to wait and watch and see which companies are succeeding. And that's where you put the brunt of your capital.
Awesome. So if I kind of rehash and understand it correctly, so it sounds like the companies are able to go out. This is typically for companies before they've raised any capital. Is that correct?
It is. It's really designed for founders just to get started. So I think about this as pre-RegCF, right? They're just coming in. They're trying to figure things out. They need to raise a little bit of capital, maybe get an MVP going. Instead of going to family and friends or trying to hit the RegCF markets, which would be incredibly difficult to do, you come, raise a rights round, and then start building your community today. Go out, prove some things, bring it back to your community, and now you've got momentum going into your first RegCF round.
Got it. Now, a lot of our listeners on this show are very familiar with kind of the regulated investment crowdfunding, right? So when we talk about RegCF, Regulation Crowdfunding, Regulation A, tell us how this fits within that ecosystem. So, is this a security if they're getting a stake to invest in something? And if not, what exactly are those early backers getting with their investment?
So this is not a security based on the Howey test because you're not buying a profit interest. These venture stakes are not tradable. We're not making a market to trade them. So there's no way to sort of arbitrage on a venture stake. So from that standpoint, it doesn't meet the Howey test. It's not a security. What you're buying with a venture stake is you're buying access into that journey of that founder. So for example, someone can buy a venture stake in Doriot. And today, what you're getting is every week I'm providing an update of what's happening with our company, what we're building, what's working, what's not working. So you get an inside track into what's happening on the inside of Doriot. That's a high education value. And so that brings a lot already to the table. But then the other side of this is you get an opportunity that let's just suppose that there's massive demand for Doriot. Right? We fast forward 6 months and VCs are swarming and they want to take the entire round. I'm always going to make room for my venture stakers, and they get in no matter what what kind of demand there is. The venture stakers always get a seat at the table and get to invest in at the same rights or at the same terms as the VCs. So it really flips the script and gives the earliest risk takers a seat at the table for when these deals really do take off.
Got it. And so where I could see that being valuable is if a company you got into becomes the next super hot company, that company is now ready to raise their first RegCF round. And let's say they're going to, sell it out in a couple of days.
Right.
What you're saying is early venture stakers who are able to get one of these kind of options into it, get a seat at the table. There's a fixed allocation where they get to invest in that company's first formal round.
That's right. They get first dibs.
Awesome. Now, I know that another thing you kind of mentioned is that it's a 5-step flow, I think you kind of have on the website in terms of from stake to exit. Can you just walk me through logistically, what does this look like? Like, let's say I come and I should put out the disclaimer. So I have purchased a venture stake in Doriot here. I wanted to check it out. I think what you're doing is very interesting. I wanted to learn more about it and also be along, you and your team for the journey that you're about to embark on. So what does that look like from both the investor and the founder's perspective? If you could just walk us through a simple example.
Yeah, absolutely. And thanks for being a venture staker. So from the founder's perspective is that if you have ambitions to start a company today, you're not going to be able to go to VCs or angels or even the RegCF platforms. There's just not enough there, or not enough forum for people to invest in that. So what you typically have to do is go to family and friends, which is high risk, can be toxic. It doesn't make a lot of sense. It's a $60 billion market that just simply should not exist. And it needs to be replaced with something better, which we hope venture staking will be that replacement. Is that we want to bring, tens of thousands of venture stakers in who don't want to put a lot of capital up front, but you want to start buying optionality into startups. And so that way, by selling a rights round, it's non-dilutive to the founder. You take that money, get started, come back to your venture stakers with what you've learned and what your next move is. And that next move typically is to raise your first round of capital. And that could be through a combination of VCs, angels, and a RegCF offering. When you're a venture staker, you're going to see pitches every, so often from founders who have ambition, they've got a really bold idea, and you can make a decision whether you want to stake them for as little as $10. And if you do stake them and they're winning, you get to put $100 in each of their future rounds. So it's a hedge on both sides. It's just, let's just all take a little bit of collective risk. Let's go figure something out, and let's come back and let's see where we stand. And if we win, great. If it doesn't win, no one's put up enough capital to make it feel like it's been fatal.
Got it. I think you referred to it as your fool's tax of learning with some of these prior investments, where if you're making some of these investments, but you have to commit a lot more capital as an investor, then you find out if the company's actually going to succeed or not. It's a little bit tougher. So it's kind of a ticket to get a seat at the table. Now, I won't play devil's advocate here, but what I first thought when you told me this is, oh no, what's going to happen to the RegCF markets, the RegA markets, right? But from what it sounds like, they're not going to go away. Those companies are still going to need those rounds. This is really to get potentially more companies to make it to that point by getting funded through their community. Is that kind of an accurate portrayal? Or
yeah, as a matter of fact, I think we're going to totally blow up the RegCF market, right? And the RegA plus market. If you think about this, right, founders are still in this idea of whether they should go through community rounds. But if we can get founders in at the very beginning, start building that community, and then we're going to take them along this journey of raising community capital. And I think this could really open up the markets. When we think about venture staking, you could think about, like, for example, every university having their own community of alumni that are venture staking, their own students and their own professors, right? All of that is designed to go through RegCF rounds thereafter. So I really think this is an enabler of community capital, not prohibiting it.
Okay. And then last question kind of on my end, and then I'll see if anyone else wants to, ask you any questions. But how does the founder remain accountable, right? So a founder is going to raise this. There's no SEC filings or paperwork. What's to prevent them from taking my money and running away and, not doing anything with it?
So a lot of this is through a marketplace is a screening process that before they can raise money on our marketplace, they are going to go through a background check, a lot of screening to ensure that this is really a right fit. We're not going to judge on what their idea is, but we're certainly going to judge the character and the history of the individual. So it's not, we can't prevent fraud any more than what happens already in the Reg D market or what happens to the RegCF market. We all know that there's sort of, challenges there. But from our standpoint, we're really judging on the quality of the character of the person and their true intent and what they're trying to build here. They have to get past our screening before they can open themselves up. And after that, the venture stakers can decide the wisdom of the crowd. Do I trust this person? Do I think this person's got what it takes? And if you raise a round and you fail to keep your community updated, then you've really lost not only an opportunity, but you really have lost your credibility.
So do you see a future where founders will just be posting on Twitter trying to get people to send them money, or is all this being funned or coming through you?
No, it would absolutely all be funneled through Doriot. It's patent pending. We would enforce anyone trying to do something along these lines. We don't want this to be a free for all, right? This has got to be a controlled environment because we're here for two things. We're here to get entrepreneurs started. We're here to make money, right? And entrepreneurs need to understand your investors need to make money. And investors need to understand you need to give them a little bit of runway to go figure something out. And if you can match both of those, then the ecosystem is better. And as you know, Brian, I am all about this ecosystem and giving more opportunity to both entrepreneurs and investors.
Great. Well, I want to bring in the very famous here, Scott Katoon, Kingscrowd advisor and entrepreneur. Scott, do you have any questions for Gerry?
Yeah, I do. This is going to sound like a really stupid question, but I mean it genuinely. Venture partners spend their entire lives working on understanding what makes a founder tick, what makes a company tick, what makes a market grow. Retail investors, this is one of the challenges we face with RegCF and RegA is the crowd. Crowd wisdom is great when it's great, and crowd stupid is bad when it's bad. And you get this like kind of popularity contest turned large backing for a founder, like one of my challenges with this and some of these others that invest in like rev share as well, sometimes the crowd just doesn't have enough information, and you get like a charming, person to come in and wow you with stuff. And then next thing you know, like everyone's like, oh my God, this is so great. But in reality, it's a shitty idea. And it's really hard to suss out at a professional level. And I think I was on a show just recently talking about this, but the one area that kind of why I like RegCF and RegA so much is that it does create this like light barrier. There is some accountability to it. What you're describing, I hope will grow into that. But at first blush, it's like the only thing I would ask you is like, how do we educate and make sure that people know what they're looking at? Because I think you could easily fall into like the crowdsourcing in the wrong direction, if not mitigate.
Yeah, I think it's a great question, Scott. And I think it's important to sort of identify truly who are we going after with this. And the best model I can tell you is the Teal Fellowship. So the Teal Fellowship is, hey, don't go to school. I'll give you $100,000, go figure something out. They have produced more unicorns percentage-wise than Y Combinator, right? Because they simply just gave a little bit of capital to some very, very intelligent people, and they ended up creating Figma and Ethereum and so on and so forth. This is the same model, right? So you're really betting 100% on the jockey, right? You're not betting on the idea. This is really you being able to see, is this person the right person who's going to go out and just want to win, right? And so you don't have a lot of information, but you're also not betting a lot, right? If you're just a $10 venture staker, hey, I'll give you $10. I'll spot you 10, right? Yeah. If you're in a different income bracket,
I love that idea.
I'll spot you $100. I'll spot you 100. I'll spot you 1,000. But you know what? I'm not giving you anything more until you produce. That's it. This is what you get from me. And if you're not making us happy, you flamed your way to a failed RegCF round. You won't continue. It's really what it comes down to. You won't be able to continue.
Yeah, no, I like that model, and I can see a lot of activity there. I think, like the Teal model, and this is not just for him, there's a couple others that do this, but like the real secret behind his model is a lot of times actually that it's his ideas and stuff that he's incubated and he's funding them. And he's picking people who like he knows worked first, second, third degree, PayPal, father of X person. Like I wish that it was so easy as to be like, here's a genius from MIT and here's $5 million, like just go race. The reality is like a lot of those ideas are very incubated, which is a super effective model. So, I mean, if you can capture that, I think all the power to you. I think it's just that the only thing that I look out for in these deals is always just the founder, like kind of can sell really well, sneaks through, and I don't want it to go south for you because one bad apple. That's the part that just becomes really difficult. But otherwise, I think this is awesome.
I appreciate that sentiment, and I think you're spot on. It's so much of this has to be screening, credibility, and those are things that we have to confront, no question about it.
Very cool.
And I think for those just additional reading, we won't dive into it, but you kind of have been alluding to and mentioning this thing called the power law, and people should look it up if they don't know about it and how it works and how that drives returns, especially for early stage companies and investing, because yes, there are going to be failures. In fact, you might have more failures than successes, but what really matters is can you get a few of those really big successes that are just out of this world? Well, thank you, Gerry, for that overview of venture staking. For our next segment, I'm going to welcome the Kingscrowd Senior Investment Associate, Teddy Lyons. And Teddy this week put together a chart that looked at healthcare pharma trends in investment crowdfunding. Teddy, I'll bring up the chart, but why don't you kick things off and tell us a little bit about the data that you looked at for this week?
Yeah, so I kind of start by kind of laying out the thesis that I have and a lot of other medtech investors do, which is that early stage medtech, biotech, life sciences, drug development are generally pretty big blind spots for traditional venture capital investors and even some angel investors. And the reason for this is a lot of these companies obviously need to raise substantial amounts of money to get through preclinical animal trials and then into human clinical trials. And a lot of times these companies do not have any clinical data yet. And because of that, venture capital firms and seasoned angel investors won't necessarily touch them because it's just too early and therefore too risky. Once these companies do get meaningful trial data, the valuation is already spiked significantly, and a lot of times, these valuations they skyrocket very, very quickly as soon as there is any meaningful trial data. And then it becomes too late for early stage VC firms to get involved and have line of sight into 10x. We've historically seen a lot of these early stage medtech companies raising equity crowdfunding rounds, RegCF, RegA rounds. And I think, there are still a lot of companies that are not so great in this space to invest in. But if you can look at some and find some de-risked medtech biopharma startups in the equity crowdfunding space, I think there's an opportunity for some really outsized returns here. And, most of the time you're not competing with, the traditional VCs to get access to these rounds. So, because these companies are looking to the online markets. So, some of the things we look for just quickly are, a company attempting to get 510K FDA clearance, which is a much faster and less expensive clearance to have to get than a de novo FDA approval, which takes significant amounts of capital and kind of large clinical studies. So, so it's really getting a sense of, if there is some early clinical data, kind of what is that showing? How does that translate into what a future approval might look like and a timeline for that? So anyway, just main point being is that equity crowdfunding has become a very popular avenue for a lot of these early stage pharma and medtech companies to raise capital. So kind of see here in the nascent stages of the industry of equity crowdfunding as an industry, 2018 to 2020, pretty low funding amounts. And then really 2021 through last year, you really see strong levels of aggregate funding in early stage healthcare and pharma. And I think we're just going to see that continue moving forward. And then if you look at RegA, is obviously, as we all know, a different type of industry. It is a lot of times, especially here, we see a lot of these funding amounts are dominated by like two companies. So if you look at 2020 and 2022, now RX raised like 20 million each of those years. So like that accounted for half of the 2020 numbers and a substantial part of the 2022 numbers. We all know RegA is, requires a lot more money to run a RegA round and to get those funded. So, you see the deal count is a lot lower. And really in the last couple of years, you've kind of seen RegA activity in early stage healthcare and early stage pharmaceuticals kind of decline pretty heavily, but we still see kind of strong funding amounts on the RegCF side. So yeah, curious anyone else's thoughts on kind of, especially, equity crowdfunding being used as kind of this kind of bridging type of rounds for companies that operate in very capital intensive industries like early
I just want to point out one interesting kind of counter trend that's shown here in the data. So if you look at the overall RegCF market, it really peaked back with kind of that public market peak post-COVID in 2021 and 2022. And most of the charts and most of the industries, if you look at them, kind of had a peak around then and then kind of come down and level off. This is interesting that, in terms of healthcare, biopharma, we're actually seeing 2024 the most capital raised. So I'm very curious, what might be some of the trends driving that. But another thing, I don't know if it is happening. I wonder if some of those companies that may have been previously going for a 75 million Reg A are now like, hey, let's just raise a $5 million Reg CF instead, and maybe utilizing Reg CF. Gerry, I know you also look at a lot in this space. I'm just curious, any takeaways in terms of trends or even deals that you're seeing in this industry?
Yeah, I think there's a couple of things that jump out at me. I agree with you, Brian, that it's a lot cheaper to run a Reg CF round, raise 5 million, and I don't know what the success rates have been. What is the average amount that's been raised on the Reg A plus? Maybe the cost benefit just wasn't there. You're spending way too much money trying to raise too little money, and then you got the compliance issues on top. So it makes sense that if you're not surpassing the $5 million anyways on these crowd equity funding rounds, then you would go Reg CF. The other thing that jumps out at me is that, I think one of the hardest areas of Reg CF is the B2B, because most retail investors don't understand that, but they can understand pain. They can understand a medical issue. They may have, family members or friends that are dealing with that particular medical issue, so they can resonate with that more so, and they're willing to give that a shot, and they're not professional investors where you're like, I need more form, and they're willing to take a little bit more risk. So it just seems like a natural place for these companies to come to fund some of their early R&D.
I would add to Gerry there. I think 100% agree with you on that. I think that the relatability is a big factor. I think that the last 2.5 years of AI and robotics and automation focus and investment has driven all of these groups out into the public, and people are like, oh, I get it. Like, used to show the miso robotics and the tossing pizzas and all this other stuff. And now it's like, I actually get the gist here. And a lot of these things are growing. You see Start Engine, for example, is like probably the largest platform for these type of deals, or at least it seems that way in the data that I see. So I think you're seeing like non-traditional rounds for these type of companies. They take a lot of money in between rounds. They take a lot of money to get R&D off the ground. And I think the story, I think you could talk about Boxable as another example here, even though it's not the same thing. The story is visual. And I think one of the things, this goes back to the point I made earlier to Gerry about Doriot and the crowd understanding, crowd knowledge, is that when you're not a sophisticated financial planning investor, or you're not a sophisticated founder operator investor, you rely on visuals. And I think when you start looking at med tech, you understand it because you probably experienced it, your wife, your father, your grandmother, your mother, whatever, your child. When you start seeing robotics and automation, like, I don't have to send you a pitch deck for you to get what it does. Here's a video. This is what it does. Can you see manufacturers across the universe using this? Absolutely. We need this much money. We know people at Stryker. It just like makes sense for a regular Joe to hear the whole pitch. And I think it's probably one of the reasons you see less venture companies that are in the complicated LLM business going to our retail portals, because I think the explanation of what LLM is and how it works and multimodal, and you get into all this stuff, and I think it loses the retail investor really quickly. They struggle with it.
Yeah, those are all really excellent points. And also just looking at the chart again, I noticed the number of rounds in 2022 was 148 versus fewer rounds in 2024. So it sounds like even the average
more money
going into some of those. And Gerry, going back to your point, I ran the data the other day. That's the only reason I know this stat, but fewer than 80% of all RegA companies raise less than $10 million, basically. Oh. So that's,
there's no point in paying for it.
Why would you spend $500,000, $1 million for your disclosures, your financials, your audit, and everything if you're going to raise less than 10 million? So I bet it's probably a combination of a lot of these trends. But Gerry, we've very much enjoyed having you here today. Thank you for joining us. And again, for everyone else who's listening, make sure you head over to kingscrowd.com. We have a great weekly newsletter. We get a lot of these data-driven insights, a lot of this news, these podcasts, the charts, and everything else we've talked about here today. So until next week, we'll sign off. Thanks, everyone.